Okay, so the problem with investing is the tax position, or in fact, just having the investment in the wrong tax structure. So the first thing I want to look at here is gross ROI. Everyone looks at the exciting return on investment on a product description, and they may say, well, it's 7-8% return, but what is it after tax? And then you have a different picture altogether. Another problem I see is net income on interest versus gross income. Again, because you may be an additional rate taxpayer, high rate taxpayer, you could be seeing your income being smashed by 40%, if not 45%. And even dividends, there is a income tax rate for additional rate taxpayers of 39%, 39.35 to be specific. And that's a lot of money just to give away to HMRC based on something you felt was the right investment. Not using a company structure, I've just mentioned that the income tax for additional rate taxpayer on dividends is 39.35, and yet dividends received in a limited company is 0%. And admittedly, you have to take the money out, but there are fairer ways of extracting money out of a limited company, reducing it to less than 39.35%. Then we've got investments held in the wrong structure. So even if you have investments in couples' names, it may be in the high rate taxpayer's name. As a result of that, they will have the greater amount of tax to pay versus if those income generating assets was in the lower tax earner, so husband, wife, civil partner. And that's really a shame because, well, that's such an easy thing to do. But the problem is with easy things to do, it's easy not to do as well. So you end up paying more tax simply because you're really not looking at the tax position as a family as a whole. And then not reviewing returns or tax position on investments. And what I mean by the returns is, well, how much money are you generating? People have lots of money invested in pensions, but most of my friends that I speak to tell me regularly that they do not look at the annual statement for that pension. So in most cases, if you look at the gross amount returned in a year, less the fees, may actually be a lot less than most other investment products. Or indeed, it could be less than inflation, which means that your pension money is eroding over time. And that is because you're not looking at it enough times to make a decision to move it to a better returning investment structure. So what are the solutions in this? So lower taxes, higher returns. That's really what you got to look for, is looking at a position that says, well, hey, we want to look at my net net return position. So after tax, not before. It's kind of pointless looking at before returns. We need to look at the after tax position. So a couple of things you can do straight off the bat is use ISAs. They're tax-free. Some SIPs, because a SIP is a pension, so you could make pension contributions, invest in a SIP and control it yourself. Use gilts. All of those could be very good for tax-free investing and give good returns if you invest in the right thing. I want you to look at both the return on investment that people tell you that this exciting investment has for you, but I want you to then look at it from a net after tax position and see what the percentages are. Finally, use a company to make investments. If you've exhausted your SIP and ISA, maybe as a high rate taxpayer, additional rate taxpayer, it may be more sensible to loan money to a limited company, and that limited company can then make investments. And that's what I typically call a family investment company or just a investment company. It really doesn't make much difference from a shareholding perspective for this purpose of this video. But I do think that using limited companies is a great way of making investments for you. Some of the things that you should do: split assets between couples. If you're a high rate taxpayer receiving dividends and interest, then is it not better to give that share to your spouse? Transfers between husband and wife, no capital gains tax. Time your disposals. So if you know that you've got £3,000 worth of CGT annual exemption, then you want to make sure you get up to that limit and then maybe make some disposals the following year to keep under that 0% tax rate. Review your investment reports regularly. This is really an unfortunate thing I do see a lot of, is that people make the investment, get excited about it, so then just leave it in their kind of trash can or in their inbox for their email when it comes along and just don't pay any attention to it, which is a real shame because you're probably spending more time looking at new investments rather than looking after your existing ones, which probably are suffering. And finally, use company to make investments. Clearly, I've mentioned that a couple of times, but I want to get that through, that using a company structure could well be useful. If you're really interested in knowing how to make investments in the right tax structure to generate the most returns, feel free to use that QR code to discuss our services. So some of the examples I have to make is looking at a gross return on investment. It could be 5%, which after tax could be just 3%, where that's not so exciting, is it? You look at it from a 5%, then it drops to 3% because of tax. But if you used a different investment of 4%, which may not be as attractive, but you did that in a company, then actually you could have just kept that 4%. So looking at gross perspective versus net again isn't the best use of your time. Looking at things like 10,000 annual gains after allowances. So we're talking about selling stocks, shares, property maybe, and you've got £10,000 after your annual exemptions. And because you've got the 2,400 tax, 24% for high rate taxpayers, if you timed it correctly or split the asset between husband, wife, civil partner, that tax rate could actually have been 0. And again, we see a lot of people make disposals of assets without really thinking about the tax position. Oh, I need the money now, let's sell it, and then pay the tax. So it's like, well, that's really quite a heavy cost to the amount of money you get out. Again, planning. Buy-to-let may make a loss in your own name because of Section 24 mortgage interest relief cap, and yet if you use a limited company, it could actually make profit. That is the impact that having property in a company versus personal name really does have for a lot of our clients. Interest tax at 45%, and again, if you have it in an ISA, I do see people not using ISAs properly. We can help you with that. We can get you in contact with the right people to manage your ISAs properly. But there are people that have money in bank accounts and they are going to be taxed at 45% because they're an additional rate taxpayer. That's pretty much half of the interest that they earn. Keeping it in an ISA and all that money is yours. So hopefully that's been useful. I am a UK property tax specialist, but also an investment tax specialist. So feel free to go to our website or indeed book a 10-minute discovery call with us using that QR code, or the link will be in the description box below. Thank you.